Hey guys, Dr. Tom Carr of drstocks.com, drstoxx.com. Hey, just a quick reminder, use half off as a coupon code when you go to buy all 5 of our market letters. You'll get 50% off your first monthly or quarterly payment, and that's good for the month of July. Half off, HALFOFF, all one word. Okay, let's talk today quickly about how I think we're at a near-term top in this very sharp post-Brexit rally. I don't exactly know why the market's rallying so hard when you've got the Fed poised to raise interest rates. You've got potential problems of all sorts happening on the Brexit vote. So it's rallying. What can you do? You just trade the trend. That's what we do. In any case, we also want to be cautious when it does seem like we're at a near-term top or near-term bottom. I think we're at a near-term top, and I'll tell you why. Let's take a look at the VIX index. This is an indicator I like to use to determine pivot points in the market, at least to let me know when we're close to one. And as you probably know, the VIX index tracks the implied volatility of option pricing on the S&P 500. Now those are options that are only traded by the big money players, the smart money players. And so when implied volatility goes up, generally speaking, that means the big money players are expecting higher volatility in the market. So they're hedging against their bets and so on. They're pushing the prices for options higher. And when they feel very comfortable with the market, they're buying stocks like crazy. They tend to not hedge as much, so they're not buying as many options, and the implied volatility of the S&P 500 options goes down. That's what the VIX tracks. So in other words, when the VIX goes down, the market is generally speaking going up, and when the VIX goes up, the market is going down or expected to go down. Right now, the VIX is at a very low place. We're under 13. We're very close to 12, which, as you can see, 12 is an absolute bottom, and it's been that way for months and months. It did spend a little time under 12 back in 2015, but that was a long time ago. And it hasn't been under 12 since August of last year. And you can see that when it did soar, when it did fall under 12, it soared tremendously higher from that point, way, way higher. Now, we're down here, we tagged about 12.15 this morning, and we're closing now on the VIX at around 12.77. Anything under 13, as far as I'm concerned, looks to me like a near-term bottom in the VIX. And so while I'm not expecting the market to just fall tomorrow, I am expecting that I'm concerned that we're at a near-term top. We may trade sideways for a while and then fall. We may trade sideways for a while and put in another leg higher. Who knows? But all I'm saying is that I don't think that the upside edge is nearly as strong right now as the downside edge. So I would be very wary of my open longs. I would start to hedge some of my positions with maybe something like the SPXS, which will fall 3 times faster than the S&P 500. Sorry, it will rise 3 times faster than the S&P 500 falls. And there are a variety of other ETFs, leveraged and unleveraged, that you can buy to short or hedge the market. I would suggest doing that for the next few trading sessions, because it does look to me like we are at a near-term bottom according to the VIX. I also want to point out that there is a little bit of bullish divergence here off this recent low. We see that in the CCI indicator. You don't see that in the RSI just yet. We're not really oversold in the RSI, but it doesn't get oversold very often. And I do think that we're heading for a bit of a market fall, if not just a pullback, a shallow pullback at least. All right, God bless you guys. We will see you soon.